Well, I see my role as not only just providing the finance, but actually being an educator. I like to really talk a young couple through all the process as far as savings, because the savings, they might have sufficient money to buy a house, however it might not be considered genuine savings. And genuine savings are very critical as far as a lender is concerned. Genuine savings are considered to be the amount of money that you've either saved over a prolonged period of time, generally 6 months, with regular payments to achieve a figure of about 5% or 5% of the purchase price. Either that or having 5% of the purchase price in a bank account in the applicant's name for that 6-month period. It shows a level of commitment and maturity in not spending it. Either maturity and commitment to saving it, or maturity in having the money and not spending it. And it's there for one purpose. Well, obviously it's my role to show the prospective first home buyer what may be available to them to buy their home, and to do the calculations as to the amount of deposit they have or need, and what benefits they can achieve by having maybe the stamp duty, the transfer stamp duty waived, and in some cases a cash payment from the government to encourage them to buy a home. So my role is to educate them on how to go and do the research, do their own research, to find out what may be available to them and lead them to the conclusion that they can or can't buy the home that they've got their mind set on. Well, LVR stands for loan to valuation ratio, and it's what the banks rely upon to determine how much equity you have in the house or in the property you're buying. So when the banks want to lend you some money, they do a valuation on the property, and your loan is then determined as a ratio of the value of your property through that valuation. The 80% level is a magical figure, whereby if you have a 20% deposit, then you're going to avoid lender's mortgage insurance, which is a very painful cost that you have to meet. Lender's mortgage insurance is insurance coverage, obviously, which protects the lender in the event that you can't make your payments. People have the misconception that lender's mortgage insurance will protect the borrower, and it doesn't. In actual fact, if in fact you default on your loan and the lender goes to the mortgage insurer to be compensated for any loss that they encounter when they've sold the property, the mortgage insurer unfortunately will come to the borrower and make you pay what they've paid to the lender. It's a two-edged sword. In one way, it'll help you borrow more than the 80%, because you can borrow potentially up to 95% of the purchase price of the property, but you pay the insurance. And the less deposit you have, the more expensive that mortgage insurance is. It's a one-off payment. It possibly can be added to the loan when you apply for the loan, but if it's at the maximum, say 90% or 95%, you have to cover that cost, and it can be many thousands of dollars. When you take out a home loan, you have to pay back the loan amount. So if you've borrowed $100,000, you've got to pay back $100,000 plus the interest for the time it's taken you to pay that $100,000 back. The usual loan term now is about 30 years. And if you paid that $100,000 over that 30-year period with equal monthly instalments, in the end you would have paid about $200,000. The amount of interest is about the same as the amount you've borrowed. So if you can reduce that from 30 years down to 25 years, you're going to save interest. If you can get it even less, you're going to save more interest. So what we do at Finance Bureau is to show you all the ways that you can reduce the interest that you're paying on your loan, using offset accounts, paying more frequently, such as paying fortnightly. Just fortnightly payments will reduce your loan term from 30 years down to 25 and a half. That's incredible, just paying half of your monthly payment every fortnight. And it's because you're making some extra payments during the year, but it's theoretically pretty much the same as what you pay now when you pay monthly. But if you've paid 4.5 years less off your loan, that's 4.5 years less payments. So let's say 48 payments, 48 of your monthly payments is a lot of money you've saved, and that's all interest. If you then use other techniques that we have, you can possibly get your loan down from 25 years down to 22.5 or even 20 years, just by following a simple process. Well, after we've had our initial discussion about what they require, and we're leading towards an application, I need to be able to identify exactly what their salaries are and their wages. So we look, obviously, their pay slips. We also need their PAYG summary for last year and balances in their savings account for their deposit. There are other things we need, such as we need to confirm their identity and with a driver's licence and passport or driver's licence and things like that. It's very simple. But a lender wants to see what you have in regard to your savings, what your income is, and what your liabilities are. So if you've got credit cards, they also want to see the last statement for your credit card, just to prove what the limit is on the card and that you've made your normal payments. In regard to how long it takes for the application to proceed, it can be very quick actually. Generally, the first interview, maybe an hour. We can cover all of the things that are required to prepare an application, and once it's submitted, it might only be 2 or 3 days before it's approved. A valuation might be required, but if you've got a really good deposit, say 20%, most lenders don't even require a valuation. They'll just take the contract of sale as the value of the property. If you have a 10% deposit or less than 20%, the mortgage insurers require a valuation, and that might take 3 days. So in the time that the lender's approving the loan, the valuation's done, they match up and marry up together at the lender, and the loan's approved. After that, it might only take 4 or 5 weeks for the loan to settle and you move into your new home.